Today on InvestTalk, we unpack why gold is moving to an all-time high. Then we review the market moves ahead of tomorrow's big jobs data. We also answer questions about the BITO ETF, NVR homes, RCI hospitality, and more. And at the end, I look at how the Chinese economy may be able to rebound.
This is InvestTalk, independent thinking, shared success.
Our main focus point is about gold and why gold prices are soaring. And I don't know if you know this, but gold is having a much better year than almost any asset that is out there in dollar terms. It's beaten all major stock markets year to date, okay, in dollar terms. And the very rich are fueling a run on storage vaults to hold their gold bars as well. And standard gold bars saw its value rise over $1 million for the first time. And what's most interesting about this run is that still not a lot of people are talking about it. Not a lot of people are allocated towards gold. And that means there's still a lot more potential fuel to this run. Okay. And there's been a surprising level of indifference in the gold market to a relatively strong dollar up until late, and interest rates being elevated in positive real rates. Okay. And so, what happens if the dollar falls? What happens if real rates go negative once again, like they have been for a while, or it had been for a while? So it's a very interesting time in the gold market. And the big question is, what is going on? Why are we in this bull market? And in short, gold is simply is best suited to being used as physical money. Why? Because it does not depend on the creditworthiness of any other entity to retain its value. Okay, it's durable, meaning you can hold it for long periods of time and it doesn't rust. It's fungible, meaning you can one bit is the same as another bit. Okay, it's no different. It's divisible as well, and the amount of gold being dug up every year is typically 1% to 2% over long periods of time. Okay, so it's not like there's a ton coming onto market to devalue it regularly, and so that's the positives of gold. Now, it isn't very convenient. But money is more of a technology than anything else. In many ways, gold is base money, and then there is the technology of money. Right? Think of the net payment networks of Visa and MasterCard and bank networks and things like that, and that obviously advances. But gold, being in many ways base money, it holds a lot of intrinsic value, and it's really fallback money. Okay, it's valuable fallback money, and a lot of people really think gold is an end of the world asset, and it's really not. It's really an alternative to a financial system that has issues, and we know that. And most countries around the world don't have the stability of the US, the UK, a lot of the developed markets, okay? And a lot of people take that for granted. For example, an extreme situation, think of Venezuela, right? There's been, the hyperinflation there. Those people in Venezuela much rather hold their assets in gold than they would in the bolivar, right? That continues to devalue. And in many ways, the amount of debt in the developed world means that we are becoming more and more like the emerging market countries throughout time. And that means the gold holding its intrinsic value suddenly becomes a lot more interesting, a lot more applicable to today's environment. Okay. And, ETFs and trend followers are just starting to jump on board. And central banks continue to grow their hoards because of geopolitical complications. China and Russia, yes, their free market capitalism has infiltrated them a little bit, but it hasn't brought them on board to being friends of ours. And obviously, there's still a contentiousness between the East and the West. And the global hegemony of the US dollar is coming into question, especially when we confiscated the treasuries from Russia after the invasion of Ukraine. So it was pretty clear, obviously, that, hey, if you don't agree with the United States in your politics, then they can go and take your stuff. And so it's much better for those countries to have more political and geopolitical freedom to, instead of put their money into treasuries, to put their money into gold. And so that's happening in a big, big way. They don't want to be cut off from the world's monetary system. And so the fallback money of gold makes a lot of sense for a lot of these central banks. And so for the average investor, you have to really look at gold as portfolio insurance and separate from really all the other asset classes that you might hold. And I had that caller earlier asking, how much should they hold? Well, once again, it depends on your risk tolerance level, depends on your other assets, but 5 to 25% is the range you should probably be thinking. Okay, and gold to me is a forever asset in some ways because of its lack of correlation to a lot of other assets. And central banks continually buy and hold even at the bottom. So if they're doing it, why aren't you? Now you can also own silver, you can hold gold miners, you can hold others within the space, but gold should, I think, always be the base of that alternative asset and safety within your portfolio. And especially in times like these, due to geopolitical concerns, due to our debt situation as a country, both in many different developed economies, gold continues to do well and is likely to remain so for some time. Let's take a look at the market today. It's kind of a mixed day overall, mixed to down. The NASDAQ was up slightly, about 0.25%. The S&P down about 30 basis points. The Dow down 54 basis points. And you had a few big movers. You had, what were the big positive movers? No one real that noticeable. You had a few industrial names down big. The Verizon is buying out Frontier Communications. So that was kind of a big news on the day. NEO is up 14%. That was kind of the biggest mover on the day. But a mixed bag as we head into the jobs number tomorrow. And that will tell us a lot about the state of the jobs market and whether the Fed needs to cut 25 basis points or 50 basis points. And that should certainly spark some market volatility. And remember, volatility can happen both directions. So that could be to the upside or the downside. And we will see tomorrow after the announcement in the morning. So that was the market today. But let's head over to, what are we doing, a call?
Hello, gentlemen. This is David from San Jose. Had a question regarding a power utility company I'm thinking about investing in. The stock symbol is AQN. I'd like to get your thoughts on it and a good price to get in. Thank you for all you do.
Oh, this is very interesting. This is AQN, Algonquin Power and Utilities. This is out of Oakville, Ontario. So it looks like it's a Canadian name. And the problem here is this is in a strong downtrend. The technicals are very bad. Earnings are supposed to fall 13% this year, 19% again next year. They fell 15% last year and 13% the year before. So the earning trends are very, very bad. They earned 70 cents in 2021, and next year they're supposed to only earn 37 cents. So I don't know why you'd be interested in this name. Yes, it's a utility company, but it's in renewable energy space. We know that space is struggling, and their business is struggling mightily. Free cash flow is negative. Return on equity is only 1.7%, extremely low. They have a lot of debt on their balance sheet, and the technicals, once again, are very bad. I rather short this name than buy it. Much rather short this name. This name looks like it's ready to go much, much lower. So absolutely run far, far away and very, very fast from AQN, Algonquin Power and Utilities Corp. Thanks for the call. Let's tackle another caller question now.
Hi, I had a question regarding the overall asset allocation. So I know you guys are big on having a diversified, balanced portfolio. But seeing as how most people have the bulk of their assets in either the stock market via 401ks and 529s and IRAs and et cetera, or real estate, what are your thoughts on alternative assets and how much of the overall portfolio should have assets outside of real estate and the stock market? So, for example, gold or Bitcoin or whatever else. Curious to hear your thoughts. Thanks.
I do think everyone should have some sort of gold exposure to some degree. Now, I think that could be as little as 3 to 5% of their total assets and as high as 20%, 25% of their total assets. It definitely varies widely depending on your risk level, what those other assets are, how much correlation they might have to gold, for example, how much other commodity exposure do you have. But definitely, I think that is important. Now, you're talking about other alternatives. Alternatives is a very broad category. There are, there's private equity, there's private debt funds. I think those tend to be drastically overrated and very, very opaque as to what exactly is in them. They tend to be very illiquid, et cetera. So I don't love a ton of that in a portfolio, although, sprinkles of it can be fine. But I do like your general thought process of, hey, I need to diversify a bit more beyond just equities and real estate and even bonds and into things that have less correlation to all of it. So I think gold, especially in this time, is a good way to go. So thanks for the call, and I love that you are thinking about that in the right way. Now, I hope you've been telling your friends about the InvestTalk podcast being available in video form over on our YouTube channel. And we get questions all the time via the comments section, and let's tackle one of those now. Derek Johnson 5219 says, I had a question about NVR. Would you buy it at the current level? It seems like the price, it doesn't seem like the price is going down anytime soon. Well, this is NVR is a home builder, and I love this question. Why? Because NVR's price is trading at $9,044 per share, the close today. And a lot of people say, oh my God, it's so expensive. No, it's not expensive, especially in relation to earnings. So it's earning $499 per share this year, $527 next year. So based on forward-looking earnings, it's trading 18, 19 times earnings. And what do? They build single-family homes, townhomes, condominiums in 15 different states. And it is a very well-run home builder. And so a lot of people will say, it's too expensive for me to buy. Well, yeah, maybe nominally to get decent diversification. So that may be difficult, right? You buy one share, it's $9,000. If you have a $50,000 portfolio, that's 20% roughly of the portfolio. That can be hard. Okay, so I understand that. But if you have a hefty amount of money, right, a couple $100,000 or more, buying one share of this is not that big of a deal. And they don't have any debt, really long-term debt on their balance sheet. Free cash flow is about $1.5 billion on a $26 billion enterprise value. That's pretty solid. So return on equity is 38%. So a lot of positive things to like here. They do continue to buy back shares consistently with that cash flow. So overall, the home builders, I do think, are set for a bit of a pullback, especially if you get a weaker jobs number tomorrow and the jobs data continues to weaken. But I like what you're looking at. It's definitely one of the best home builders out there. And if you have a large enough portfolio, there's nothing wrong with adding it on a pullback. And where would the good support level be? Well, it would probably be right around the 8,000 level, which would be the 100-day moving average, as well as the recent breakout area. And there's a decent chance you get there over the next 6 to 9 months if the jobs market weakens. So I'm going to give NVR a thumbs up, and I love that you aren't shying away from those companies trading at $9,000 per share.
Hey, Luke and Justin. I wanted to get your thoughts on creating a whole portfolio, keeping it very simple, just on ETFs, and if that would be considered very well diversified. For example, just different sectors of getting ETFs in growth sector, utilities, energy, technology, maybe keeping it to around 6 to 8 ETFs for a whole portfolio that are just all different sector ETFs. I wanted to get your thoughts to see if that would be a decent strategy to be a very hands-off, but yet, a very diversified portfolio that could grow substantially over time. Know what you guys do. Thank you so much.
Well, first off, any growth type of ETF is going to be not a sector ETF. That's what is called a style factor, okay? Growth or value, large versus small. Those are style factors, okay? Now, there are a ton of sector ETFs, and I think that's kind of what you're talking about, right? Industrials, financials, technology, utilities, etc. And I have no problem with building that out and getting a better allocation overall than you are going to get with just a broad index. We know the broad indices are heavily weighted towards just a handful of sectors, right? If you look at the S&P, for example, it's going to be heavily technology. Let me see. Right now, currently, you're looking at 30% technology, and then the next is 13% financial services, 12% healthcare, and then everything else is single digits. I mean, you're at 3.74% in energy, which is way, way too low. Even industrials are just shy of 10%. So I like the idea of maybe taking all of those and readjusting the allocation, right? A lot less technology, a lot more energy, a lot more basic materials, a lot more industrials, financials, 13%. That's probably in the right ballpark, et cetera. But doing a bit of a rebalance, I think, makes a lot of sense. And so I have no issue with that, especially if you don't have the time, the data, the discipline, the expertise to buy individual stocks. You are getting broad diversification when you're buying those sector ETFs. And then you can kind of create your own index in a way using those sector ETFs. Okay. So I have no issue with that. But it's just a matter of understanding, what is a sector ETF and what is not. Thanks for the call. Now let's talk a little bit about China. And China's GDP growth recently has disappointed. And they do have a growth target around 5% this year, but that's facing headwinds. And the slowdown is still likely to prompt some level of policy change from the top. And in order to hit their longer term goal, which is doubling their per capita GDP by 2035, 11 years from now. Now, they did grow about 5.3% in the first quarter, but it's been slowing since then. And really, it's about the property sector continuing to slump. Now, the state council's annual growth target more recently said, well, it talked about around, and that's really the big detail here, is that, yeah, it's 5%, but it's more around 5%. So what is around? Is 4.5 good enough? Okay. We shall see, because they're north of 4.5. I think UBS right now has 4.6 is their expectation for growth this year in the Chinese economy compared to their earlier forecast of 4.9. So it is coming down closer to that 4.5 level. But is that good enough? Is 4.4 still around 5%? And I think their policy prescription for this is going to tell a lot about how dedicated they are to that. Now, it's an economy they're continuing to try to figure out how do they manufacture growth without further exacerbating the property bubble that continues to deflate. Now, they've done a few things to lower mortgage rates, but a lot of that stimulus around the housing market has waned as of late. Okay, and so this is a tall order to continue to hit these policy goals, which they need to grow at about 4.8% per year for 15 years to get to that target. Okay, and the intensity of the reaction of a slower economy there is going to be very interesting, not just for China itself, but the global economy. What does that mean for global growth? Are they stimulating? Remember, it's not just about the Fed. When it comes to liquidity in markets, it's not just about the Fed. Because think about it. If there is a central bank around the world, they're stimulating, they are incentivizing their businesses, for instance, to go out there and borrow money, right? They're borrowing money. It's growing the amount of money into the system, their system, and maybe they'll take some of that and go and buy dollars or go and buy domestic goods here in the United States or services. And so when you're looking at the global economy, it's not just about the Fed. It's how many central banks are easing. And right now, the only one that isn't is now the Bank of Japan. Now obviously we have not here in the United States, except for reducing QT. That is one thing that happened just a few months ago. And obviously there will be a rate cut at this meeting this month. So that will mark, basically every central bank cutting to some degree over the past year, besides the Bank of Japan. And that is positive for global liquidity. And we'll see, is China going to do that again? Are they going to try to lower rates? Are they going to try to stimulate their economy using the liquidity spigot, shall we say? And so all of this is very important to see where the next leg of growth will come from. And we'll be continuing to watch, how dedicated is China to that 5%-ish target that they have set. Now let's pivot over to another question from the InvestTalk YouTube channel. Khalil Tiger, I believe how you pronounce it, says, long-term listener here, how do you guys feel about BITO, B-I-T-O? This is the ProShares Bitcoin strategy. Let me pull this up here on a few of my systems. Now, first off, Bitcoin is in a downtrend. It's that simple. This is BITO peaked out back in March, right around the time of the Bitcoin ETF approval. And this has sunk from 33 all the way down to 17 today versus, what is IBIT doing? I believe, if I'm remembering correctly, IBIT is doing far better, since it launched. And I don't see any reason why you'd want to buy BITO. I believe, if I remember, the expense ratio is very high, 95. I also believe they're using futures, not spot Bitcoin as well. And so, this is probably one of the worst ones that you would want to own, BITO has been trading, let's see, it's down. What's it down this year? It's up this year, up 30% still. Versus IBIT, I'm just using one of, am I looking at the right one? Yeah, IBIT. And let me look at the performance of that one. I don't have that one. Let me see. My system didn't give it to me. Oh, because it didn't start the year. It started on January 11th. But basically, it's up much, much more and doing much, much better, especially since that peak. So I would either own an IBIT versus a BITO because obviously recent performance, the fees there as well. IBIT, its fees are 12 basis points versus 95 for BITO. And like I said, from what I remember, I believe BITO uses futures, and there's some rolling costs there, and it's probably one of the last ETFs I would get exposure to Bitcoin with, and I wouldn't even get exposure to Bitcoin right now, so I'd pass on it. Now, we have time to play another caller question. As you know, this came in earlier on 888-99 chart.
Hello, my name is Michael out of Nashville, and I love your show, and I would like to have your opinion on the stock Taseko Mines, symbol TGB. It's a copper mining company out of Canada, and I'd just like to know your opinion on that company before I invest. Thank you very much.
All right, looking at TGB. This is a Canadian company that mines for copper and gold. Let's see. It has mines in the British Columbia, Canada, as well as Arizona here in the United States. Okay, so one thing I like about it is domiciled in stable regions. That's one thing to think about when you're buying actual individual producers of commodities. When they're operating in kind of third world type regions, the rule of law can get kind of funky. And that adds another level of risk to their asset. When they are in the US and Canada, in this case, you don't really have to worry too much about that. And so that's one thing I like. Now, market cap is 582 million. It's a small cap name, so it's going to be very volatile. Return on equity is 18%. I like that. And they do have a decent amount of debt on their balance sheet, though, $539 million in long-term debt. That's pretty hefty. The free cash flow is positive, but not by a whole lot, especially compared to its market cap. So I like it. This would be a high-risk copper play. This moved from $1.10 back in October all the way to $3.10 at the peak in May. Now we're down to $1.98, call it $2. And so you can see that level of volatility. And so if you are looking for a name that's going to really, really crush if copper goes up, then this is a good name. It's a solid name because of that levered balance sheet, small cap nature of it. And so it just depends on your risk level. We own some copper names. They tend to be bigger, mid, large cap companies. And, for us and our clients, we want the safety a little bit more. And they pay dividends as well. So we like that returning of capital to shareholders. Not huge dividends, but some. And so I would rather go with that. But hey, if you're looking for the most upside, this could easily go from 2 to 4 in the next move up in prices of copper. So this depends on your risk level. Okay. Now let's talk a little bit about active ETFs, and they're poised to hit $1 trillion in assets for the first time, maybe this month. At the end of July, total assets in active ETFs, meaning ETFs that aren't just tracking an index, reached $974 billion. And that's a huge increase. That's since 2018. 2018, that's when the total number of assets reached $100 billion in the space. So in just a span of, it's gone up 10 times in just a span of 6 years. That's huge growth. 48% annualized growth. And the total number of active ETFs has more than quadrupled over that same period to 2,761. So there's a lot out there. And this still pales in comparison to the $13.8 trillion at the end of last year in active mutual funds. But that is reversing. Actually, over $2.5 trillion came out of active mutual funds in the last year. So what you're seeing is a shift more towards active ETFs of all different flavors, all different kinds. And I think this is a trend that will continue. It'll give you a lot more opportunities to buy more tax efficient vehicles. They tend to be more tax efficient than those mutual funds. And it's something I love to see because I think there's a lot of great strategies out there. Now, what I will say is most of that money is going towards option-based strategies, covered call strategies, for example, which I think have a place and I think can be good, but I think can be a bit overrated, especially those that track an index. So, interesting story.
This is John from Lakeland, Florida. This may be a bit of a juvenile question, but I wanted to know, in your opinion, what are your top 5 technicals to focus on, either to buy an individual stock or hold on to an individual stock? I appreciate your time and look forward to hearing from what you have to say. Thank you all.
All right. Great question. I'll start off with number 1, price. Sounds simple, but that's most important. Is price going up or is price going down? Is it making higher highs or higher lows? That is number 1. Okay. So there's the first technical indicator, which is very overlooked. Number 2, simple moving averages. 50, 100 day, 20 day, 200 day. Those are the 4 that are on my charts. Okay. Very simple, straightforward. You can use exponential, but I like simple. Keep it simple. Keep it simple, stupid. Okay. So those are the basics. Okay. Third would be MACD, moving average convergence divergence line. Always keeping that on there. See if there's some level of divergence on the chart. Is it making a new high while the MACD is not, and vice versa? Those are good. I also like Williams %R as an overbought, oversold indicator, something that I continually watch. So that would probably be number 4, just to see kind of near term, is it oversold or is it overbought, to know, should I be getting in now, or should I be maybe trimming my position if I'm thinking about rebalancing in some way, shape, or form. And then lastly, I'll go with Bollinger Bands. I love Bollinger Bands. They give you a sense of, where consolidation is happening or not. Is it running up too far too fast? Is it moving outside of those Bollinger Bands? And that typically means you're likely headed for a consolidation period one way or another. So those would be my top 5, and try to keep it as simple as possible. Now, when people take the time to leave an InvestTalk podcast review on iTunes, we like to thank them for the courtesy by getting to their question quickly. So let's do that right now. Twisted Straw says, is Rick RCI Holdings a worthwhile hold? RIC. And this is, if I remember correctly, top of my head, I believe this is is this the strip club REIT? Yes, it is. Operates 69 establishments that offer live adult entertainment and or restaurant and bar operations. Okay. So funds from operation peaked in 2022, $5.38, was down 9% to $4.90 last year, down 33% expected this year to $3.27. I don't know what's happening in the adult entertainment industry, but clearly things are not going well, at least for Rick. The dividend yield is less than 1% here. The trends are very poor. Relative strength, only 14. That's very bad. Last quarter, revenues were down 1%. Earnings were up, or funds from operation were up 4%. But in this quarter, estimates are -4 on revenue and -37% on funds from operation. And that's similar for next quarter as well. So I don't see a lot to like here. Based on the numbers, the trends are poor on both the fundamental and the technical front. Let me look at its balance sheet to see they do have a good amount of debt on their balance sheet, $374 million market cap and $245 million in long-term debt. I just don't see it. I really don't. I don't know why this would be something to get excited about. It's just in a downtrend in many respects. So I'm going to pass on RCI Hospitality Holdings, RICK. Well, as I wrap up today, let me remind you that the KPP Financial InvestTalk Wealth Webinar is coming up in a little over a month. It's free to sign up and attend, and it focuses on effective ways to managing your 401k and enhancing your retirement savings. And it's all happening, once again, October 8th at 11 a.m. Pacific time. So head over to our website and register. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. Independent thinking, shared success. This is InvestTalk. Good night.